Forex Focus brought to you by IG. Super happy to have our friend Paul Cappetta with us once again to talk about a very important topic. Paul, thanks for joining, because US dollar has started to turn around in the last 24 to 48 hours based on a really mid-tier job data number, but it's kind of signaled some alarms for a bunch of traders that, hey guys, the upcoming high priority job data, non-farms, and inflation data with PCE and then CPI to come in a couple of weeks, that stuff might be really, really relevant and set the course for a potential US dollar rally like we've seen the last couple of months, but also could set the course for a potential crash here. Why don't you talk a little bit about what we saw in this job number, why it was so significant, the lowest since March 2021?
Yes, so I mean, the big thing with the job market is you really didn't have to pay attention to it for the last year and a half plus. It didn't move markets. I mean, we were still trying to figure out why we were paying attention to non-farm payrolls on Friday, but now it looks like it's coming back into the purview. The job market's just been so hot. It's been a great job market if you're looking for a new job, basically, for anybody. There was more openings for a long time than there was people that were unemployed, basically. So the job market's been great, but now it's starting to show some weakness. Now, these data points are always lagging, could be seasonality, anything like that. So it's something you have to keep an eye on now. So basically add it to your inflation watch. You're going to now have to watch the job market along with interest rates. So it'll be interesting moving forward. I'm really interested in basically you get Eurozone inflation in the morning tomorrow and then PCE, and then you get non-farm payrolls to round out the week. So it's going to be an exciting end to the week here. Yeah,
great point that this data isn't important until it is. And what's really nice is we have these high priority data points set to come out, that PCE and that non-farm. And this lower one, it kind of alerted everybody to like, hey, this might be some important stuff. We might be at a turning point, because you saw the price action here, Paul, and this always tells you what's important and what's not. And I thought it was really, really interesting. You and I were, in the office this morning and talking about the fact that dollar yen was putting in new highs on the year. And you can see the last couple months here, it's been a tear for US dollar to the upside. And it felt like on this morning that it was like, man, another leg higher here in dollar yen. Do they get up to 150? Reversed that day and has since, in the last 24 hours, fallen almost 200 pips. The dollar has. This could be a turning point here. And what would you necessarily expect to see from the US dollar if the inflation data were to come in one way versus the other? Because it might kind of confuse people a little bit, this idea of like, wait, so, US jobs data is bad, and so how does that reflect in these different forex pairs? Now looking forward to the PCE number that's coming out and the non-farm number, and maybe you can paint it in a little bit of the perspective of U.S. interest rates, and then go from there, kind of like the path for a good or bad number.
Yeah, sure. So I mean, we got job openings, which was Tuesday. And then this morning we got ADP, which is a different job metric that you get, and then you get non-farm on Friday. So the ADP also came in soft, so showing some softening in the job market. Now, what does that mean for interest rates or the dollar? Because the interest rate's going to tie to your dollar story. So a softer economy, softer job market, you always have to remember the Fed has a dual mandate. Their dual mandate is low unemployment and low inflation, basically. So if the job market is starting to softening, maybe they take a look at not hiking moving forward. Now, has Powell said anything in the last week that's changed his mind about inflation? No, he hasn't talked, so that's always something to keep an eye on. But say inflation tomorrow, you have two ways. It comes in hot, or it comes in basically at the forecasted level, or it comes in soft. If it comes in soft, you're going to see interest rates kind of par back their gains from earlier in the month. and then you'll see some weakness in the dollar there. On the flip side, if inflation comes in hotter than expected, you can see basically the opposite things. Interest rates are gonna tick up again, and you're gonna see the dollar strengthen. Again, you always have to remember there's seasonality on a lot of these metrics. If you think about the summer, people spend lots of money in the summer. Typically, that's higher demand. Doesn't mean that inflation has to tick up, though.
Yeah, absolutely, and very well described there. The route from a number like the non-farm number that's coming out or the inflation number. It is kind of like if either of them come in hotter than expected, higher than expected, then that might be reason for more interest rate hikes, reason for U.S. dollar bullishness. What we've seen, obviously, the last 24 hours is two different job data points come in lower than expected. Interest rate markets move lower in the U.S. and U.S. dollar give back some ground, especially against the yen, the euro, and the pound here. And yeah, pretty significant that you see the chances of a September rate hike. I mean, they weren't super high, Paul, but it is significant to go from 20 to 25% where they were 2 days ago to now be under 10%, essentially going from maybe we'll get there, maybe around a 1 standard deviation chance there, to now being a real outlier if they were to hike. And those odds for the rest of the year of another rate hike also really falling significantly over the course of the last 24 to 48 hours with this turnaround in U.S. dollar. But it's really important, I think, to hit this note here that yes, it's been, a crazy short-term effect. U.S. dollar has fallen, 100 pips, 200 pips against some of these major pairs. But if some of this U.S. data comes in softer, the Fed has less of a reason to keep interest rates high for the foreseeable future. In pairs like U.S. dollar versus Japanese yen, there's a lot of ground to cover to the downside if that data gets on a roll. I mean, we're back above 145 here, which historically, if you take out some of last year's outliers, this is really rarefied air for this dollar. And like I say, could the nice thing about Japan having essentially no change in interest rates over the last couple of years, it is kind of like a neutral pair for the U.S. dollar, whereby if rates go up in the U.S., dollar goes up, and you don't have to worry about Japan's rates kind of obfuscating the story at all. But now, if this data continues to hit on the unders, and Japan, we know, is pretty much not changing anything, that dollar could see some significant downside. I mean, your history here with IG over the last, several years, you're used to a dollar yen that's in the 110, 120 handle, and we're still at 145.
Yeah, I mean, we're talking about 2,500 points to move on the downside. That's a big move. Obviously, in general, it's not going to happen all at once, but if you see it, it can you'll see it start to form in your charts, and you'll see it trickle down if the U.S. data continues to hit unders. On the Japanese front, they have if you pay attention at night, and this is what happens if you're on Twitter at night and you follow some accounts, but you'll see some comments from the Bank of Japan, and they're very interesting. They're talking about getting rates to zero from negative, which is a change, and they're saying it's not tightening monetary policy, even though it is. So we'll see how that kind of situation develops. We're going to have to start to pay attention to BOJ a little bit more. Same thing we do with the ECB and the Fed, and the Bank of England for that matter. But yeah, it'll be interesting to move here forward. But this can go back quickly if the data in the U.S. starts to kind of show some softness, basically.
Yeah, absolutely. And yeah, it would be a welcome addition if the Bank of Japan decides to wake up and do anything here. But yeah, for the time being, the fact that they're hovering around 0% kind of lets you trade that U.S. dollar, or at least look at the U.S. dollar against someone who's relatively neutral. So we'll see about all of that. The data that is coming up, here are the expectations, Paul, and I wanted to get your view on how you think the market is positioned for this. not necessarily, what you think the market does if it comes in 4.1% with the core PCE, or if non-farm comes in 160 or 180. But it seems like the last 24 hours worth of action has kind of moved these expectations down slightly. The fact that interest rates have been moving lower for the last 24 hours, stocks have been moving higher for the last 24 hours, feels like these expectations now are maybe like 0.1% lower for the core PCE that's due to come out tomorrow, or maybe like 5 to 10K lower for non-farm. It feels like, I guess what I'm getting at, and what I want to hear from your viewpoint, it feels like if we get 4.2% in PCE, then that's going to be maybe a bullish number for dollar and a bearish number for stocks, given that they seem to be kind of pricing in an under.
Yeah, I mean, the market has kind of moved in an interesting way. They really the JOLTS number really killed the dollar on Tuesday. I can't remember if I was in a meeting or I was just getting ready. It was early in the morning and was doing something else, and I'd see the dollars moving all over the place.
Huge move.
Yeah, it's not something you were kind of expecting, because the job numbers have been rather mundane lately. So it was a big move there. Now with PCE, we've talked about this previously. It's different than CPI and what it prices in. You did have a little bit higher oil prices, so you have to take that into account in July, August, basically. So you have to take that into account. There's, again, all sorts of different pieces to this, but we'll see. I mean, if we get 4.2, I would be more in the camp of it's going to be more of a flat day. If we get something like 4.3, the dollar is going to rocket. But if you get 4.1 or 4, the dollar sell-off will continue. With non-farms, I think if you get 170, that's probably a change in pace from the ADP and JOLTS report that we got earlier. So
Yeah, absolutely. Great insight there on that. And we'll go out with this great tool that IG provides on these markets and lets you know where traders are positioned in terms of this potential for a US dollar turnaround. Of course, not indicative of what's going to happen in the future, but 77% of IG clients with positions in dollar yen short that US dollar, as a majority of traders in the market here are positioned on the side of a potential US dollar, at least bearishness, maybe not necessarily positioned for a full-on crash, but on the short side of the dollar. Anyways, Paul Cappetta, everybody, thanks so much for joining us here for today's Forex Focus.